Hello, and welcome to the Geopolitics Explained podcast. Last week, I released 2 episodes on the topic of fiscal dominance. The first covered the history of fiscal dominance before Friday's episode, in which I discussed general economic indicators that could imply that a nation is experiencing some early signs of fiscal dominance, before then exploring some nations in the world today that possess some of these indicators. In Friday's episode, I only discussed the United States loosely. As a result of that, in today's episode, we're going to take a deep dive into fiscal dominance and the United States. As a nation that has huge financial sway in our world, fiscal dominance in the United States would be one of the most consequential cases ever seen. So, is it inevitable that fiscal dominance will arrive in the United States, or can this current economic environment be navigated? Two key characteristics that we'll explore today when exploring fiscal dominance in the United States is monetary policy and inflation. Starting with monetary policy, in 2022, we saw the Federal Reserve begin to raise interest rates to counter inflation. The general idea here is that higher interest rates lead to less borrowing, because at higher interest rates, more interest is paid on debt. As a result of this, higher interest rates typically lead to less spending. Since there is less spending in these environments, inflation, which is the rate at which prices rise, naturally falls. Despite inflation today remaining elevated above the 2% target, it has been successfully lowered from the peak levels that we saw a few years ago. We are now in a rate cutting process where interest rates are being lowered. The context of this process is vital in the discussion of fiscal dominance. This is because central bank independence in the United States is now being questioned, which is one of the prime indicators of fiscal dominance. Jerome Powell will leave his role as Federal Reserve Chairman in May of 2026, and he has stood firm against political pressure from Donald Trump to lower interest rates while inflation remains above target. However, Trump has 5 candidates lined up as a potential replacement for Powell, and the expectation is that these candidates have been chosen because they will enact Trump's hopes of lower interest rates. Trump continues to go after his domestic opponents, as we discussed in an episode in October of the Geopolitics Explained podcast, and the Federal Reserve is no exception to this rule. After Powell leaves the role, Trump will do all in his power to make sure that an ally sits at the head of the Federal Reserve. The most important question from this takeaway is, why does Trump want lower interest rates? Well, there are many reasons for this. The first being that Trump is known to favour a booming stock market, since this makes financial market players happy. Happy people are more likely to vote for political continuity rather than political change. Also, with most of Trump's personal wealth in financial assets, he also benefits himself from a strong stock market. Trump also wants to lower interest rates, so interest rate payments will be lower, and that this will free up fiscal space for tax cuts, which Trump promised in his manifesto. The final reason for lower interest rates is that Trump wants to grow the United States out of its current debt burden. If a country's economy grows faster than its debt, the relative debt burden decreases. To give a quick analogy, if a country owes $1 trillion in debt and its GDP is $2 trillion, then its debt to GDP ratio is 50%. If a country undergoes an economic boom and its GDP grows to 3 trillion, but debt remains at 1 trillion, then this debt to GDP ratio falls to 33%. This means that less money will then be spent on interest payments in relation to what our country makes from its economic growth. If we look at the United States and the current position they're in, their national debt is at $38.2 trillion. US GDP is around $31.5 trillion. This equates to a total federal debt to GDP ratio of 121%. As a result of this, the United States is worth less than the total amount of debt that it has. This is why the United States wants to reduce its debt to GDP ratio. Increasing economic growth can reduce this ratio, but decreasing debt can also reduce this ratio. Trump is currently seeking to pursue some growth in the United States through investment from trade deals and also from increasing the US's domestic manufacturing base to expand exports. It's important to note that with this investment coming from abroad, it won't have a large impact on raising US debt. But the United States does continue to issue debt for other spending. This is a contributing reason as to why Trump wants to lower interest rates. So, in general, Trump wants higher growth and lower debt. Where this situation grows even more interesting is when we introduce inflation. Inflation in the United States remains at 3% as of September 2025. If Trump pushes interest rates down while inflation is above target, real interest rates could turn negative. Real interest rates are the nominal interest rate, which is the rate that's set by the central bank, minus the rate of inflation. A negative real rate occurs when the inflation rate is higher than the interest rate. This means that we are losing more value through inflation than we gain through interest rates if we choose to hold our money at the bank. In such an environment, more borrowing, spending, and debt-financed investment is encouraged because interest rates are low and inflation is eroding the value of money, so it's best to spend it now. But in an environment where we see a rise in spending, this also raises the risk of inflation rising further. In the worst cases, this creates an inflationary spiral. As we've discussed during this series on fiscal dominance, when inflation starts to rise, the typical strategy is to raise interest rates, just as we saw the United States undertake in 2022. Fiscal dominance emerges when this strategy isn't pursued. Instead, a nation lowers interest rates and lets inflation rise. The worry is that Trump could do this. Trump could lower rates and let inflation run because higher inflation also makes debt easier to handle. To give an example, if a country owes $1 trillion and inflation rises, the total amount of debt stays at $1 trillion. But inflation makes a currency worth less. As a result, this $1 trillion in real terms, which means accounting for inflation, is now worth less and it's easier to pay off. This is especially beneficial for a nation that can print money, as the United States can. Although this too can be inflationary, just as we saw in the United States in the aftermath of the pandemic. Reducing the national debt is great for a nation that is currently strained by its debt burdens, as the United States is. It would spend less on interest payments, and as a result of this, the nation would have more to spend. In general, this sounds like it would benefit everyone. But unfortunately, higher inflation, as we learnt in the post-COVID era, erodes savings and erodes the value of money. As a result, everyday goods and services grow more expensive. Now, we as individuals have no control or say in this system, and yet in high-income countries, economic inequality continues to worsen because the rate of inflation is typically higher than the rate of wage rises. It's notable that wage rises can also contribute to an inflationary spiral, but the key point here is that people suffer because of elevated inflation. Now, it goes without saying that something has to be done about the US having higher debt levels than it does gross domestic product. As I discussed earlier, this can be done through growth, or it can be done by inflating the debt away. The question that many will seek to find the answer to is, which will Trump choose? It's also notable that he could potentially choose both. One worry with the United States attempting to grow their way out of the debt is whether there is enough growth available for the United States to do this successfully. They did do this once before, after World War II, as we discussed in last episode, where we explored historical examples of fiscal dominance. But today, the United States doesn't have incredible demographic growth, nor is experiencing a productivity boom that we saw back then. It was these tailwinds that supported the United States in growing its way out of its post-war debt. The question today is, where could a potential productivity boom come from? Now, this could arise from future technology, of course. The United States is one of the leading technological powers in the world. One area of innovation that people immediately think of is artificial intelligence, but currently there are risks of an AI bubble through generated artificial demand surrounding OpenAI and NVIDIA. In the last quarter, SoftBank sold its entire NVIDIA stake and Peter Thiel's fund followed. The story of a potential AI bubble is gaining traction. Now, I just wanted to include that section because I find it interesting, but this AI thesis doesn't negate other sectors from potentially experiencing productivity booms. But today, it's difficult to locate where such a boom could form. As a result of the United States not having many tailwinds when it comes to areas for potential growth, it seems that they could be somewhat reliant upon foreign investment. This is a precarious position to be in, but we are seeing Trump, through his tariff negotiation strategy, actually find significant investment from other nations. The question is, for how long will this continue? The alternative strategy, as we've alluded to outside of growth, is that Trump lets inflation run to erode the real value of debt. Next episode, I will dive more into the details surrounding this issue and the United States' current economic position. I wanted today's episode to set the scene and the groundworks of potential fiscal dominance in the United States before we then dive into the direction that we could see it heading. Next episode, I'll discuss US consumers, inflation expectations, trade deals, and supply chain constraints. If that sounds of interest to you, keep an eye out for that episode, which will likely be released on Friday. That's all for today. If you enjoyed this episode, why not leave a review on the podcast platform of your choice? It really helps out the podcast. I've also currently got a 20% off offer on my premium readership over on Substack. The link for that will be in the description. I've been Dylan. I'll talk to you next time.